Good morning and welcome everybody to the second in this series of IMAC webinars on the issues around transforming advice into wealth management. In Monday's session, we had a couple of participants, Andrew Tracy from JB Wears and Scott Fletcher from Woodbury's, who approached this issue from a high net wealth perspective. Both of them focused primarily on wholesale and high net worth clients. But today, we're going to be talking about wealth management in the context of accountancy-based advice. And we're fortunate enough to be joined today by Matthew Walker from Dynamic Asset Consulting and a partner in WLM Accounting, and Michael Rees-Evans, who recently joined William Buck as director in their Financial Planning and Wealth division. And again, Paul Forbes has been kind enough to act as a moderator for this series. Paul is the CEO of the Australian Advice Network and runs his own advice practice in Robina, in Queensland. Before I hand over to Paul, let me just say a couple of things about upcoming events for IMAC. The awards. The awards are an opportunity for us to really try and showcase best practice in the development of managed accounts. We have 5 asset class categories: Australian equities, small caps, fixed income, international equities, and multi-asset class. An innovation category. The criteria for that are very simple. Explain why what you do is innovative, explain how it advances managed accounts. And a licensee category, which is effectively the multi-asset class offered specifically through a licensee. And where one of the things we ask you to tell us about is the way in which your advice philosophy is articulated through your managed account portfolios. But we also have a new category this year, which is the Esg and Responsible Investing category. So this is an opportunity for us to showcase the way in which ESG is being delivered through managed account portfolios. It seems to me that all of the practices that I work with that use managed accounts either already have developed an ESG suite or are actively in that process. So I'd encourage you to enter your portfolios. On the 2nd of June, we're going to be running a webinar on the quality of advice review. We'll be assisting with a submission by Adrian Qua to the quality of advice review. And one of the things we want to be particularly focused on is what is the quality of advice review trying to achieve? And to what extent does it reflect the way in which advice is actually delivered, created and delivered? And how can, as a profession, we make that a better, more affordable outcome delivered to more people? And then importantly, in June, we'll be running our Advice in Action conference, 14th of June in Melbourne, 16th of June in Sydney, and the 21st of June in Brisbane. I'm not going to go through the agenda in detail, but suffice to say that, like today's webinar, we'll be focusing not purely on managed accounts, but on the ways in which advice practices are becoming better businesses, things they're doing that make them better able to serve the needs of advice clients. We're lucky enough to have Mike Pope, the General Manager of La Vista, and clearly a very experienced advice practitioner, act as MC for all 3 sessions. And you'll see from the agenda that it's a mix of technology, ESG issues, managed account issues, high net wealth issues. So we'd welcome you joining us at one of those 3 venues. Now, how to ask a question, you'll all be familiar with this. Paul will be managing the questions as we go through. If things come up, put in the question straight away and Paul will deal with it either there and then or later in the session. So thanks very much for joining us. It's now my pleasure to hand over to Paul Forbes to introduce our two panelists, participants today. Thanks, Paul.
Thanks, Toby, and thanks everyone for joining us. I'd have to say there's, after Monday's session, which was dealing with quite large businesses, and both those businesses tend to work with either high net wealths or ultra high net wealths, more in the wholesale space. I think this one will be actually able to get far more into the nitty gritty around running an MDA or an SMA style portfolio, especially for the people listening more for the boutique style and the larger practices out there. And to help us with that, we've got Matt Walker, and I'm going to pass to Matt and Michael to introduce themselves. But Matt is eminently qualified. He's actually gone through this whole process himself, so we're going to expand a bit on that. And Michael, while new to the New South Wales business in William Buck, has been running or been involved in running MDAs in a number of previous businesses, and I'll let him talk you through that. But both of these gentlemen come eminently qualified to talk about that. And I suppose it still comes down to thinking about the advice versus wealth management piece. So on that part, I'll just pass to Matt, if you want to quickly introduce yourself, Matt.
Yeah, thanks, Paul, and good afternoon, everybody. Matthew Walker from Dynamic Asset. By way of a bit of background, I'm a certified financial planner of some 30 years. So I've been around traps for the last 25 of those years. I've owned and operated my own business, and that's in conjunction with accounting, and currently a non-executive director at WLM Financial Services, which is Chartered Accounting and Financial Planning. So I have some skin in the game, so to speak, in terms of what we're talking about today. In terms of what started us on this particular journey was over the first 20 years or so of my career, we were, like many financial planners, doing the risk profiles, the standard deliverables that we are trained to deliver to our clients. Then it came along a GFC, which disrupted markets for a little while. I'm sure everyone remembers that. And out of the back of the GFC, we just felt some general discontent that what we were delivering to our clients didn't match up with our own personal value proposition and what we expected to deliver it to our clients, or perhaps more importantly, what our clients expected us to deliver.
Yeah. So we might just stop, we might hold there, Matt. We'll just get Michael to talk through his background, and then we might come back and just continue that, if that's okay.
Sure.
Yeah.
Thanks, Paul. So yes, I'm Michael Rees-Evans. I'm now a director of William Buck in the New South Wales. We're sort of a federation of state-based firms. That's also known as a partner. Some firms call it partner. So we're kind of partner. We're a top 10 accounting firm, and I'm sort of a partner director of the wealth division. Before that, probably since about 2016, I was a director of a self-licensed wealth business, which was one of the largest account practices left Count and joined us. So it's very much an combined accounting and financial planning firm. But really, even since I started financial planning, when I started the journey, when I moved from management consulting to financial planning in 2002, the firm that I consulted to and then bought into and learned my skills as a financial planner and became a CFP in 2006 through, was also intimately involved in an accounting firm. We were co-located. There was a Hill Ross practice in those days. So I suppose since I've been advising from 2002 onwards, I've been very intimately working with accounting firms. However, it's probably only since 2012 when I set up my own license that I've actually been embedded and working with, and I suppose jointly working with clients with accounting firms.
Cool.
Thanks, enough background for now.
Yeah, no, that's good. That's good for now. One of the interesting points, and we will draw this out later on, is that both Matt and Michael have been working with accountants for a number of years. And I think all of us have worked in somewhere around that space. So part of their solutions, I think, will also reflect that background of dealing with accountants. We might actually talk a little bit about that as we go as well. So if I can, pardon, sorry to cut you off there, Matt, but if we can, sorry, if we can go back to that, I know exactly what you're saying, because GFC was, we had a similar issue during the GFC where we went in to replace a manager. A business like ours, we had 500 or 600 clients, but 330 ROAs to resolve to move a manager out. And we too started to think about the time that the legacy issue, it took us almost a year to get all that done by the time we chased everyone down and got them to sign off. But B, the impact on the business, just what should be a simple change. And then we went, is there better solutions? So it sounds to me that's probably part of that thinking for you as well. Is that fair?
It is. Part of it was philosophical in terms of what did we want to be to our clients? What did we want to deliver? What is the quality of advice that we wanted to deliver? And as financial planners, our focus is more on strategy. How do we get a client from A to B? What are their goals? What do they need to do to structure themselves, the tax, the asset protections, all the usual bits and pieces. And we noticed there was a disconnect between what they wanted to achieve and the current methodology, the investment strategies of SAA, which is based on a risk profile, which was, how do you feel, not what do you need? So there was a bit of a disconnect, and I think that reflected in our clients. So we just had a look around the world as to, well, what are people doing that's any different? How do we deliver a better, more appropriate portfolio management solution to our clients? And what does that look like? We came after a number of years of looking around the world. There's the risk profiling or the SAA approach, which is what we're familiar with in Australia and is used out of the market with so forth. So everyone's familiar with that. There's a lot of traction around lifestyle planning, where you just de-risk as you get older, so to speak. But that's only appropriate for certain clients. Certainly wasn't appropriate for most of our clients. For example, a high net worth individual didn't need to be conservative when they retired because they had far more wealth than they actually needed. So they could still, on the long end, take more risk without necessarily going into the shell. And then there were the endowment funds run out of Harvard, Warburton, MIT, and currently the Future Fund is run the similar sort of way. Where we ended up was, philosophically, we wanted to match our goals-based advice up to goals-based investing or outcomes-based investing. Now, the best way to deliver that is through a more dynamic, active asset allocation approach, because it's more forward-looking. You only invest into assets that you think are going to deliver to the mandate, and you can deliver a higher probability outcome to clients. If you then had a look at, if I want to be more dynamic, if I want to have a more flexible mandate, how do I achieve that through executing? And managed accounts came to the fore there, because you can, through a managed account, use the technology to be able to manage the assets more appropriately. So back to your point there, Paul, in the traditional sense where you're using a wrap or doing it direct and so forth, if you wanted to change an asset, you've got to do an SOA or an ROA. And particularly around GFC or at times of turmoil where you thought, I need to change an asset quickly because I don't believe it's in the best interest of my clients anymore, it's almost impossible to go and write all those SOAs, have the conversations, get the letters of authority and execute. Yeah. It's just, so the inertia is basically you stay with what you're doing and then you roll out the old platitudes. Oh, it's time in the market, not timing. We'll see it through. We're not doing any worse than anybody else, which didn't really sit very comfortably with us. We wanted a better way to do that.
Yeah, and I think, Matt, one of the things you raised is it's not fair. FASIA has this fairness, treat all clients fairly, and it's impossible when you're in ROA land. You've got to prioritize, and however you prioritize is going to be unfair for the ones that aren't in the priority.
Well, correct. I'd actually suggest, Michael, that under the current wrap or individually owned assets, if you're trying to look after an entire client base, and one of the FASIA rules is treat all clients equally, you can't comply.
Yeah. Exactly. That's the point I'm making. Yeah, it's impossible. Yeah, and
that's probably a good point to go to, Michael. So, I mean, you've built these solutions and run them in previous lives. You moved into William Buck, and you look at William Buck and you go, no, this is a well-known brand, strong reputation, and they've probably brought you in to start looking at these sort of solutions. I suppose the question always is what problem you're trying to solve, but also I think from their point of view, why haven't they gone down this track in the past? Can I ask that question without leading to any grief internally?
I think it's a short 3-letter word.
Okay.
Tax. But I would suggest that it's also without inferring or implying anything negative, it's probably they hadn't necessarily had the understanding, the bandwidth of the various solutions there are to manage both tax and managed accounts. And I think, like Matt, the GFC was extremely formative for me. I started advising, I can't remember if it was in the tech wreck or just before or just after the tech wreck. And then we had the boom where everything went up to 2007 until the subprime crisis. At that time, we had about 80% of our clients on Asgard under limited authority to operate, which we were managing under the MDA rules as they were at the time, but it was a no consent letter, the platform. Christmas Eve, 2007, we were very concerned about systemic risks to clients in mortgage funds, where we, like many advisors, had been regarding mortgage funds as short-term and cash-like, and we suddenly realized this is a serious problem. And within a day, we sold out all of our clients from all mortgage funds on Christmas Eve, because we had effectively an MDA. We had the ability to, so we didn't have to. We explained to clients in January, but we were concerned that we didn't have the time to send out 600 statement advice and all the stuff we said. So I suppose that was very formative to me, saying this is a great solution. But as ASIC started changing the no platform approach and saying you need proper MDAs, and from that formative experience, I said we need another way. So that came to, skipping a few years. Incidentally, when I was at the trust company, we were the first MBA license in Australia, and I was the responsible manager of that, but it was not really well done, in my view, in terms of they hadn't kept pace with technology.
No offense to the trust company.
Well,
that's right.
Yeah, exactly. No, and they don't really exist anymore. And I won't say where they are because it might imply who the current owners are. But I think the idea was there, but it's about keeping pace with technology. Now we're in a very privileged position where technology can enable us to do things on a very timely basis. Sorry, I've realised I'm not answering your question now.
No, that's okay. So I think an interesting point. So you're now back, and I'm going to come back to Matt now, because I'm thinking, okay, so you're now in this, and you're looking, because the world has moved on a bit. We now have a number of solutions out there.
Yeah.
And whether there are, whether it's Net Wealth Hub, Premium, and more Stevens, I think, is where a transactional piece like yours can be built. If you were, and you've sort of got this opportunity, Matt, to sort of give some advice to Michael, given the fact that he's back down there now, you would have been sort of a few blind alleys. But once you commit to something, you're sort of locked into it, aren't you? You're sort of going to go, you're going to build it. It's hard to change the underlying providers.
Well, yes and no, Paul. In terms of, obviously, any change requires time, compliance, review, and so forth. But managed accounts, as you know, have beneficial ownership and transferable. It's harder in a retail superannuation environment, but it's not impossible. So if you're looking at it from an advisory point of view, the starting place for us was always, what do you believe and what do you want to deliver? So what is your investment philosophy? Then you get down to, how do you execute? And you can do the unit trusts, you can do the managed accounts, the MDAs, the SMAs, the IMAs, whatever an acronym you can think of, or you can go through wraps, or you can do it all direct if you want to try and avoid the fees. As Michael rightly pointed out, the technology and cost of delivering services has come back, so you don't have to go and try and do it all direct to save a few bucks. It's not that costly to go through the technology.
No.
So the managed accounts, if you reverse engineer what is best for the client and what is most effective for a business, was the solution that we came up with. And then there's a whole range of managed accounts out there. Depending upon what you believe and what you want to transact on, will also determine what managed account you should use. It's not just about cost. So when we set up our fund back in 2013, given that we are real return or outcomes based or goals based, whatever you want to call it, and we had a very flexible mandate where we can go from 0 to 100 in basically any asset class, we needed to be able to have flexibility of transactions. Now, Mason Stevens was our chosen platform at that time because it had a a completely open APL. We could trade on anything in the world, basically. And so that suited our style. Since then, we've also get onto Hub and Alan Gray. We could go onto Net Wealth, but some of the platforms still don't have the range of asset classes to execute a particular style. So it depends on how you want to execute.
Yeah. An interesting question. I think this is probably one. Sorry, Michael, do you want to comment on that?
Yeah, I was just going to say, just answering the question and looking at the couple of questions we've had in the Q&A.
Yeah.
One of the questions is, how do you move client assets? And also somebody is saying, how do you convert clients from a standard portfolio to a managed account? That does go into Matt's point, which is there's different ways of skinning the cat. And I suppose the approach we took in my the firm I left at the end of February was almost as any advisor looking at our portfolios would have thought of them as sort of normal portfolios where we just use managed funds and ETFs, nothing international. It was just everything you can get on a normal platform. That said, we moved vast majority of our clients in specie from BT and Colonial and other platforms. We moved them in, including Super. We moved them in specie into the new one. We used Wealtho2, they're now called Dash, because they were extremely flexible and we could manage portfolios very closely to the way clients were used to, which is the old ROA, do you want to make a change, go. The difference is they gave us the discretion to implement the changes and address the big issue we had, which is implementation drag. And which goes back to the initial point of why we did it, because we didn't have the time for 600 clients to go through ROAs and SOAs all the time. And virtually every client always said, yep, you're the experts, yep, we approve this, but it could take weeks. So for those clients that didn't, we had other ways, but the vast majority of our clients always accepted the advice. And so effectively from their point of view, the only difference was we could make the changes we were recommending without first asking them. So we told them we were going to, but it was for their information, and we usually gave a week's notice, say, look, this is what we're about to do. Give us a call or email if you have any questions. But we were able to move all the assets, and it was close to a normal looking portfolio.
And basically, to be honest, if the advice document actually gives you that flexibility in the first place, and it says, this is what we will be doing, and we will tell you in arrears, and the client signs up to it, that's actually, you've done the job.
And most clients thought we were doing that anyway, which I think Matt made the point earlier.
Exactly.
They think, but I thought you're doing that. How's that different? And say, well, you know, these long documents, we got them quite short, something I'm working on in the new firm, but in these long documents, well, we have to get your permission first. If you're on holiday or you're traveling or you're sick, you know, I had so many clients saying, oh, I'm going away. Just keep an eye on my portfolio. Feel free to make any changes you see fit while I'm away. I said, sorry, I'm not allowed to.
Yeah.
But with this, we were. And so it was really legally doing what the clients thought we were always doing, but weren't able to.
Yeah. Exactly. And a simple, when you're communicating to clients and you explain that sort of stuff to them, the way that we transitioned into that sort of conversation was, what we've been doing is the best we can. I've been doing a good job, and the world is changing. Technology is catching up. What we've been doing is good. We're just moving to better, and evolving with the times. So this is in your interest.
Yeah, it's an interesting one. We've had the same conversation internally here, that you have a client who sits opposite you now, and you can actually let them know you're going to do that transaction tonight, and that by tomorrow morning, on some of the trading platforms you use now, they will be able to see that change by the afternoon. So, but that certainly wasn't where we were in 2008. So,
no, and Michael raises some great points in terms of operationally. There's much reduced administration, much reduced SOA production time. You don't tap into every single client's account and buy and sell the assets, wait for the cash to clear, then go and buy the assets. You know, it removes quite a bit of the back office and the paraplanning service or the SOA side of things, but also the implementation drag. And even IMAP has done work around, if you wait a week or 2 weeks or 3 weeks or a month before you see your client and implement the recommendation that you're making, it can be quite costly over the period of time, because the best time to execute your idea is at the time you have the idea, because that's what you're seeing. Yeah. But if you have to wait 3 months till your client comes in, or if they're on holidays, it can cost quite a lot of money.
Yeah. So we're getting a few questions. I think we can probably cover off a few reasonably quickly on there. So One of the first ones was actually that we mentioned treating everyone equally, and the fact that you remove legacy with managed accounts. I think one of the questions which I would put to both of you, because you, and especially Michael, you've done the past as well. So Matthew, you're talking about more an absolute or targeted fund. So are you just built one fund? Because I know, and I might come to you, Michael, some people might go, okay, I'll build a stable fund or some form of fund and a growth fund, or a number of options. So I'll go to you first, Matt. Yeah.
Okay, so we built 5 options, and the reason for that was when we decided we were going to enter into the wealth management space, we actually took the time to sit down with our clients and ask them what they wanted.
Yeah.
Okay, so we were sick of the institutionals, people pushing their products down on us and treating us like a distribution outlet. Yeah. We actually wanted to deliver what the clients wanted. So we asked the clients. Now, clients are all different sizes and shapes, and we definitely didn't want to be a cookie cutter. We couldn't fit everyone into the same box. So when we had a look at that, different needs, different timeframes and so forth, and when you have a look at the endowment or liability matching sort of exercise of asset management, we came up with a cash plus, a substitute to term deposits, because they were painful back in the day. Yep. And still are in terms of administration. You can't charge a margin on them. They're just, we wanted a managed solution around that. Yeah. Then we had short-term money, mid-term money, and so they were cash flow buckets to satisfy sequencing risk and more appropriate allocation of assets to particular timeframes. On the longer term, people wanted to either manage the risk of their portfolios, so we built what we call a wealth protector. Yeah. Pretty imaginative bunch, aren't we?
That's right. And then, background, all that marketing.
Well, absolutely. When I was talking to my accounting partners about it, they said, I don't want any sales spill. I don't want any product push. I just want a solution for my client. Yeah. I just want to look after my client. The other side was younger people typically wanted to seek return. So we have a wealth builder. Yeah. And so those 5 portfolios run across superannuation and non-superannuation on all of the different platforms that we're on. And advisors can mix and match, a bit like a Rubik's Cube, to satisfy any particular client. So what we ended up with is effectively 5 portfolios, but they can be mixed and matched in any way for any entity to satisfy a particular goal.
Yeah. All right. So Michael, you want to talk about your previous experience, or if you're thinking of what you're going to build there, what would you be thinking?
We built 5, really, going from conservative to high growth. Yeah. We found there were not many in the conservative, but effectively they were all targets of CPI plus. Yep. With a different risk approach.
So did they align with your risk profiles? Was that what it was about?
Broadly. But ours were under a managed discretionary account, which is where you apply a range, and you say, well, we will keep you within this range of growth defensive split at all times, and we had pretty wide ranges. Yeah, not 0 to 100, but pretty wide ranges to give us reasonable discretion. But it was really built around the risk profiles. Yeah. Are we answering these questions sort of, by the way, or?
Well, we answer them as we sort of, I'll ask you questions which sort of answer that. But
because I think some of them we sort of answered in talking.
Yeah, because I think one of the other things, because there's a question there on best interest, and I think that's an interesting one, but having built them ourselves, there's ways, so 2 things, I think, from a point of view of what is a core or something. So I think you've answered, Matt, first. We've gone a different way. We said here's a core, but even that, we've gone a 65-35. And I know some people out there would go, balance should be 50-50. So everyone has a little bit of, on SAA, they have their own view on how that should be. Yeah. But I think one of the ways best interest can be answered, we do get the tax and all those, and you've got to take all these things all should be part of your decisions anyway. You guys are working with accounting firms, so are we, but taxes, you're moving someone out of a platform into a managed account and triggering a whole range of capital gains problems is not something which is going to be in the client's best interest. So there's always going to be that, the Centrelink issues, there's a whole range of pieces where clients won't be suitable for that. But I think under the managed accounts, there are some really good things on best interest, which maybe you guys would like to expand on as far as that goes.
Yeah, I mean, best interest is what it's all about. I mean, we've had that coming out of the Hayne Royal Commission, but arguably it's been the basis of the industry forever. So it should have always been that way. Yeah. So if you have a look at client best interest, one of the things that struck us out of the GFC and when we were doing our research was that even Markowitz, the inventor of the modern portfolio theory, said it doesn't work all the time. It only works in certain market conditions. Yeah. And a seminal paper that we sort of looked at was the Schroeder's is SAA flawed? Yeah. So people should have a look on the web, Google it. Is SAA flawed? Lots of commentary about 60-40 portfolios and whether or not they're appropriate. We decided that an SAA approach was not in the client's best interest. And the reason for that is that over the last 100 years, it fails 47% of the time. Yeah. That's basically a half sort of situation. Now, over the last 30 years, since the interest rates have been coming down, we've had tailwinds for growth assets. SAAs work fine. You've been able to sit there passively using index and ETFs and all that sort of stuff, and it works great. But going forward, everybody knows that there's a paradigm shift in markets. Inflation's here, rates are going up, equity markets are at lofty valuations. It's very, very challenging to see how SAA can deliver what's in the client's best interest going forward. Yeah. So if you're genuine about wanting to deliver what is in the client's best interest, you have to have a portfolio that has the capability of generating the returns that they're seeking. Yeah. It's when you get to the client level, it's not about the relative valuation. We do as well as everybody else, or we only lost 8%, not 10%. Yeah. No, that's just rubbish when it comes to clients. I just want to make sure that they're able to retire comfortably, look after their kids, whatever it may be.
Yeah, I think, Michael, and I suppose if you could draw out maybe some of the other advantages when you're going to institutions, if you were going to use institutional fund as you're going with an MDA or something, as far as discussions on fees and other bits and pieces, could we touch on those at all?
Yeah, and I suppose that does touch on a number of the questions that have been asked around, like how do you satisfy best interest moving to managed accounts because it involves complexity, tax costs. I mean, for every single, on a client by client basis, we did that analysis and we gave statement of advice explaining why it was best. And that was also a key input to the solution we came up with, which was the Welfare 2 solution. And it's not for many taste because it puts a lot of the admin on us compared to traditional platform. But for us to get the cost right down, we felt that we had the scale to do more internally that a platform traditionally did. But for every client, we had to satisfy ourselves that it actually made sense. And I think linking to, I think Peter Parker has asked a question. Thank you for using your name. It's easy to differentiate which question. How do you handle clients with direct shares and capital gains? In the same way as we always have, but in a managed account scenario, we would put a do not sell on it so that we didn't inadvertently sell it without making a conscious decision. And we would do a substitute. So, if we were, whatever we would normally buy for a client that had cash, we would substitute the direct shares instead. And then selectively choose opportunistically to sell as it made sense. And that kind of links to the sort of some of the other questions about the, the first anonymous attendee, how you treat clients equally, advisor caught between rock and hard place, no one source can meet all obligations. Absolutely, there is no one source can meet all obligations, fully agree. And so it's for us, and what we did is we worked out on, what's our client profile fairly typically, who are the people we can't move, and probably the ones we couldn't move were people with grandfathered allocated pensions where they wanted the health card. So those we ring fenced, okay, well, they're out. And so we looked at our client base and said, what solution would fit most people? And then at a client by client level, we said, okay, well, does it make sense for this client to move? And we ended up with actually a lot more than I expected in the beginning for whom it was appropriate.
Yeah, we had a similar experience there in terms of every client's got to be treated individually. But if you give yourself the toolkit to be able to mass customize, if you will, through the efficient management, you then sit down client by client and say, well, what's appropriate, what's not? It's no different to the normal advice that we've been giving as advisors for decades.
Exactly.
If in one simple way to look at it is this managed account is another product. It just has a different structure and so forth. So am I using this managed fund or this managed account Is it in my client's best interest? And if yes, transition.
Can I say one of the things which we'd sort of semi-promised our back office when we were doing all this, ROAs will be a thing of the past. We pretty quickly worked out that doesn't change, because and to answer some of those questions, then there's no such thing as 100% of clients' investments in managed accounts anyway. So at the end of it, whether it's whole locks on different shares, where it's clients who come with legacy product who want to retain it, there's always bits and pieces where managed accounts might be part of the solution, but it's very unlikely, I would say, for most of the clients we talk to, where it'd be 100% of the solution.
It's never going to be 100% of the solution. As Michael said, there's legacy stuff, there's social security or whatever it may be.
Yeah,
you can't expect exactly. And so you can't pretend that you're going to be all things to everybody. You just take care of the bulk of the business. Within our business, we manage to get about 75 to 80% across, but that's because our solutions involve direct shares or ETFs. We're totally agnostic on the asset class. Yeah. So we built a full managed diversified portfolio. So when the clients look at it, it looks very diversified and so forth anyway. It's just managed at the top end.
Yeah.
The question came through how long it took us to be able to do this. When we went through our client base, it depends on the type of client base and how often you review the clients. But effectively, we covered about 60% of the business in about 6 months, about 80% within 12 months, and the other 20% came out over the next 6 to 9 months. So it takes about 12 to 18 months.
And how many clients?
Yeah, that was about 300, 400 sort of accounts and clients.
Okay, and that's very similar to us, where I'd say we did about 350 over 18 months, but the split was probably like yours, where we had sort of the more obvious ones. So we did very similar split to you. 6 months was sort of the bulk of the easy ones, and the slowest were 18-month ones. They're often self-managed super fund clients that were you wanted a bit more understanding and control. But yeah, similar experience to you, 350 over 18 months.
Yeah, and there's two ways you can really approach it. You can either, if you have the size and the scale of capacity, you can bulk do it. So you can set aside a couple of months and say, we're going to do everybody and write an SOA, because you still need to write an SOA if you're transitioning from traditional to the more modern approach. The way we decided to do it was when a client came in for a review, we just did a review and we asked the question, are they candidates or is it appropriate that we transition to this? So it's still the advice, best interest side of things. And we just wrote it into the SOA. Instead of choosing AMP or BT or whatever product that we thought was appropriate, we suggested dynamic asset. And then you go through all the fee disclosures and all the usual bits and pieces. And technology these days allows you to get those disclosures done fairly quickly and easily if the product that you're looking at is part of that particular software.
Yeah, it's an interesting question. I think we within our license we've got 4 practices, right? So we have an investment committee and obviously a set one. But I think and you would have found this too, Michael. The success of it is simply whether or not the advisors engage with it.
Yeah, that's key.
And there was no additional revenue in it for the advisors. I mean, it was simply you can use this option or that option. And what we found was what the advisors bought into quite literally was, well, actually, I'll leave it to you guys to say, but because you would have done the same process. But there's a number of key points I thought with the managed accounts. Once the advisors worked out what it looked like, they went, well, that's what I want, because my $1 million in Sydney versus my $1 million at the Gold Coast or Sunshine Coast or Brisbane is still $1 million. So, and I've got a 55-year-old who's doing X and this sort of thing. Money doesn't know what it is. It just is it a good solution. So, so if you were trying to talk to your advisors in William Buck, for example, in New South Wales, there, Michael, what would you'd have to give them tools to say why this would be a good solution? Is that fair?
Yeah, absolutely. And it comes down to which solution you have. And that's really the art for a particular practice, is designing a solution that suits your practice. We fairly early on ruled out SMAs because we felt it gave clients the visibility without any of the control. But there's very strong arguments, for the other direction. So for us, it was really, and as a practice, with all the advisors who know all the clients, it's about coming up with what the solution is that best meets our clients' needs. And because they were part of the process, they saw that as a great solution for the clients. I mean, if it wasn't, we wouldn't have done it.
Yeah.
So it's really about having them part of the process. And I think here at William Buck, we are a bit different to my old practice in the sense that we are much more high net worth. But that said, we here use the dimensional approach a lot more, and I'm sure Matt Walker, some of his comments would have some interesting discussions over a beer or something around that later.
Diversity of thought, that's what today's about, isn't it?
Indeed. Yeah, indeed. And so here, the big thing is tax, but here we're probably fairly early in the days. What we are realizing, it kind of links a little bit to the most recent question around SOA and ROA. We're spending a lot of time here doing ROAs, or what we call EROAs, extended ROAs, which is sort of like an in-between an SOA and ROA. But I think really, I think for most, I think it's hard to believe. I think if the question is, some compliance professionals say SOA, some say ROA, what made you take the SOA approach? In our view, because it was a significant change recommending moving into managed discretionary account, that does require a statement of advice. I think I haven't seen many scenarios where I can see the record advice would suffice, because it is a significant change, and it could be a new product or a new service. It's hard to see how you'd ever have an SOA not being required. But one of the obligations of having a managed discretionary account is you need to do record advice at least every 13 months, i.e. once a year with a bit of grace, to say that it remained appropriate. But for us, it was literally a one-pager for them, because we had interactions through the year, and in that we referred to the most recent conversation we'd had, which was, and we'd always make sure that it remained appropriate. So I think that answers that question about the SOA, ROA, and also your question.
Well, in coming back to that, Michael, the distinction that we came is when you are writing about a new product and introducing a new product, which might be an MDA or an SMA, you need to write an SOA. Yeah. Once you're inside the vehicle itself, if you're looking at different buckets or different investments or whatever it may be, you can move around much more freely. Now, that might be coming down to an ROA. With an MDA, you don't need to do any of that. You just need to make sure that it's appropriate.
Within the bucket, yeah, exactly.
Yeah. So, and obviously you're outsourcing that. So, and again, that comes down to how often you're transacting and what your investment philosophy is, and so forth. So, and perhaps this leads into the next part of where you're heading with this, Paul, as to investment philosophy, resources. How do you actually execute this? I mean, it all sounds great, and setting up and running these managed accounts is fantastic. You can't obviously generate an additional revenue stream out of it unless you now separate that into separate entities, because there can't be the AFSL provider providing the retail advice and getting a benefit out of that. So that's completely cut that out. So you've either got the choice of doing all the work without getting paid, and vending it into your financial planning fee, which for some clients, particularly the high net wealth clients, becomes a very, very expensive financial planning fee, or you separate them.
So you, in your case, and we've got one of the questions actually then talking about philosophy, but I think you've pulled your asset company out of the original firm you had. You've set it up separately. Does it have its own AFSL?
Yes, it does. So with the compliance issues, obviously it's an important issue. You want to address that correctly. You don't want to trip yourself up. So we decided that the best way to do that was to separate the investment management outside of the financial planning. And that was back in 2013, before it all became law, so to speak. And it now has a separate AFSL, separate conditions, separate board, separate management. It runs with an investment committee. So if you're looking at setting these things up within your business, yes, you come up with a notional idea. Yes, you think about what you believe. Yes, you think about how you're going to execute it, what administration service you might use or not. But then you're going to say, well, how are we going to operate this thing? And you need resources for that. So Typically, these things run with an investment committee.
Yep.
Now that will, and there might be portfolio managers, maybe there's an asset consultant in there, depending upon how active you are and so forth. But that takes operational time. It takes legal structures and resources. It takes the investment committee, all the compliance around investment committee charters and all that sort of stuff. It's quite an expensive and involved process. It took us probably 2 to 3 years to build it properly, and obviously still evolving.
Yeah.
But we considered that the break even for trying to do it yourself was no less than $200 million assets under management.
Yeah.
Anything below that, you were either taking on that cost or that additional work because that's what you wanted to do. Above that, you can scale it and resource it more appropriately. So the question then becomes, depending upon where you are on that sort of scale, if you want to set this up and deliver that sort of output to your clients, are you best to do it yourself, or can you team up with someone that already delivers that and get that efficiency and scale and simplicity and the benefit of managed accounts without having to reinvent the wheel?
Yeah. And I think that also comes down to your point on philosophy, because if alignment of philosophy, funnily enough, the more practices I speak to, I don't think we're, fundamentally, we're all doing the same sort of things for clients. So if you can find someone who's already done this work, then it comes down to, if you're never going to have that scale, it's just going to be an expense. And frankly, you'll manage it poorly, from what we see. But we might just go to Michael just quickly say, from your point of view, mate, and based on just what Matt said, which I think is a good point. So if you're looking down this journey, are you thinking, okay, yes, and I know there's a lot of work to be done yet in that group, whatever direction you do take. But would you be thinking managed accounts, MDA, alternative license, those sort of things? Are they all in the mix yet, or is that something you grow to?
I think, and it kind of links to one of the questions about what you do differently, which also answered your question. I wouldn't go SMA, and where we are now, most of our money is on net wealth and BT, new BT, Panorama. And so what I would be looking at doing, which I think is based on my past experience, but also looking at this firm, it's not, there's a lot of similarities being both accounting and wealth, would be under an MDA arrangement. But with the trouble with all these TLAs, 3-letter abbreviations, SMA, MDA, IMA, is there's different ways. So some MDAs are seen as everybody gets exactly the same, whereas the one that we used, you could do quite a bit of tailoring. And so I had some clients with, sort of $9 million portfolios, and they like to feel that they have the control. So we agreed, although we had the legal right to make a change without doing so, we agreed when they went into that, we would discuss it first before implementing. And so I think and this firm I'm in now, even more the case, we need a solution that allows us to have time to have the conversation with the client. And there is that trade-off between implementation drag and having the conversation with the client. But at least it does remove the complexity of then, having the conversation, producing the documentation, getting to sign it. If they don't like it, editing the documentation. So there's a lot of back and forth. This removes all of that, and at least means you can just have it, there's a conversation and the implementation. The ideal is everybody just blindly follows and you do what's best, but reality is that won't work for most. So I think there are some good MDA solutions that do now work with both BT and NetWealth. They're not cheap, but in many ways you get what you pay for, and it's really about, are they valuable enough for the client? And I think that's the key thing.
Yeah.
We actually found, Michael, that we didn't want to be the operators of these things. And so if you go along to some of the administrators like the Mason Stevens or the NetWealth or the Hubs, they are actually the product issuer. And it all works under there. So they're running the SMA or the MDA or whatever it is and taking all that compliance side. You're just using the technology and the platform to be able to execute.
Yeah. Well, ours weren't products.
Sub-manager.
Yeah. I mean, ours weren't products because we went the MDA route, so it wasn't a product, it was a service, an FSG. So semantic, but equally, we weren't the operator because we were advisors, but we were appointed the investment manager. And so our investment committee was the one that basically built the portfolios and recommended the changes. But the administrator, the operator, executed them, and it was their job to make sure that clients were compliant in the range of the agreed investment program.
Absolutely.
Yeah.
Sorry.
Yeah, it's all right. We've only got about 3 or 4 minutes left, so I just wanted to touch a couple of quick things. There seems to be a lot of conversation back and forth on SOAs and ROAs there. Fundamentally, SOA, if you're going to change the fundamental advice you're giving, you're going to be doing an SOA. That's okay. ROA, if you're changing investment options, so you're using one version of the balance fund to another version, or an absolute return fund to another absolute return fund, strategy hasn't changed. It's an ROA. If you're building a model portfolio, then it's very likely, building some sort of portfolio, it's very likely within your license, you've already approved the underlying products. Because you're still, the investment committee, there's going to be some mirroring across the board where you go, yeah, we're going to add that because we actually want to use that in the model, do all the research before they get there. So I think there's no one's throwing weird exotic stuff into their SMAs. It's hard to get on the platforms if you are. So I'll put that one to bed.
Well, exactly, Paul. And if you're trying to, as a business, you run, typically a financial advice business will run a lot of retail super, maybe 60 to 70% of the book is retail super. Within a chartered accounting firm, there's a lot more SMSFs. So that tends to be more direct investment, maybe 50-50, 40-60, whatever it may be, depending upon the type of clients you run.
Yeah.
But if you're running a business, you're going to have retail super and investment, and you need a solution across both.
Yeah.
So when you're talking APLs, it's easy to do via the investment side, but if you're doing it via a retail super side, you've got to go through the trustee as well.
Yeah.
And so that very clearly cuts out a lot of the exotics and things like that, because we all know trustees are a reasonably conservative bunch.
I love a good liquid investment. Private equity. So gentlemen, just while we in the last couple of minutes here. So okay, it has been interesting. We got into it in 2015. So the world has changed, and now managed accounts are increasingly. We got into managed accounts in 2015, but and Matt, you were talking about 2013, and funny enough, Michael, you're going back to that same sort of era. All right, moving forward, it's now become there is actually a couple of things. There's more scrutiny of these things because it is becoming a tool being used by practices. But within your own businesses, you've got you've experienced it or probably done it. Matt, you build a solution. Next 10 years from 2023 on, world's a bit different. Do you think that changes your thinking? So I'll go to Matt and then Michael, if you could maybe talk about whether, given you've seen what's happened, if you're now building for 23 and beyond, whether that changed your thinking on what you would do in there. So Matt, for you first.
Fundamentally, no, in terms of, we've all seen the growth of managed accounts. It is the current, one of the current most effective and easiest ways to be able to scale your advice business and cut down the back office and manage client money consistently across the board. So I'd still do the managed accounts. MDA, SMA, I think it's more semantic than necessary to concern yourself with. But going forward, what I actually see the challenge is your investment philosophy and who is actually running the money. Is it the asset consultants? Is it the investment committee? Do you have portfolio managers? Who are you investing with and so forth? And the mandates they work with. Now, the reason I say that is that, again, interest rates have been falling. It's been easy in SAA land. Going forward, I think, and everybody's sort of starting to come to this point, you need to be more dynamic. You need to be more active. You need to be more selective. And so you just need to be able to execute across the toolkit that you need, but you also need the people to be able to manage it more proactively. So I think you probably need more resources. So scaling, although the advice side is easy to scale with managed accounts, running the money is going to get harder and harder. It's not just like you can choose any old one and you're going to do well. You've got to be really, really into that. So I think you're going to have to resource up on the research and portfolio management side. Investment committees are great from an oversight and compliance point of view, but typically they're not necessarily the best portfolio managers. Yeah. So I think we're going to see advisors choose between being a financial advisor, a strategic advisor, and that's their core competency, or be investment managers. I think the days where advisors are saying that they can do both this and that are going to be more challenging going forward.
Unless they stay very boutique-y.
Yeah, well, the typical advisor spends 7 to 10% of their time managing the investment portfolios and doing research, and the rest of the time financial planning and operating the business. You can't. It's very difficult to suggest that a financial advisor could spend 10% of their time and hope to outperform a full-time professional manager that is more resourced with the tools and so forth behind them.
Okay, mate. So, and Matt, sorry, it's just thrown to you now in regards to the same sort of question. 2023, do you think there's different tools, different ways you'll build it now?
I presume you meant Michael.
Sorry, Michael. Sorry. Yes.
I don't think they're different tools. It's constantly evolving. But I think, like Matt, I agree that a key thing in my last practice, the thing that I was concerned about and I think they still are. I sort of sold out of it recently. Is really have somebody that's responsible for the investment side as chief investment officer. Sounds a bit sort of more than it is, but it's that operational bridge between the investment committee and I suppose the advisors. I agree that advisors are not great portfolio managers, but it does also depend on how you do it. You know, with our practice, we were all managed funds and ETFs like traditionally, where we, you know, so that's not different. The point is you had a better consistent approach, but the problem is how do you implement it and keep it on track? Who is making sure that clients are within balance, that if somebody's done a big cash deposit, that they are, you know, rebalanced or invested out of the normal cycle. So I think, you know, going forward, it's important to have that resource, and particularly somebody in charge of the investment operations to really operationalize the decisions that come out of the investment committee.
Yeah, good stuff. All right, thank you, gentlemen. I might bring Toby back in. Cool.
Great. Look, thank you very much. That was fascinating. I mean, I've lived this for 20 years, and I found today's discussion really very interesting and very insightful. So, Paul, Matthew, Michael, thank you very much for your time. Matt, you mentioned a study which was done on the loss of value to clients from delaying implementation. So, listening to you talk about that, I went away and hunted up the graph and banged it into the PowerPoint. This is it. The work was done by Philo Capital. Looking back 20 years, assuming that your calls were about just over 50% right, what it shows over the last 20 years is that a delay of 4 weeks costs almost exactly 50% of the value that the decision would have created for clients.
Yeah. We measured it against actual client accounts that were still running traditional versus the managed account sort of space. And we reckon the transition or implementation delays cost us about 2 to 3%, depending upon how frequently the advice was reviewed. So quarterly was about 0.5%, half yearly about 1%, yearly about 2%.
Yeah.
And so that's meaningful.
Well, it's very meaningful when you think about that most advisors would struggle to rebalance the client portfolios quarterly absent a managed account, and you know, and when you compare that to the fees that are typically charged for portfolio management, it makes portfolio management a bargain. So look, Paul, Matthew, Michael, thank you very much for today's session. Next Friday, we're going to have a slightly different approach, which in fact grows very much out of today's issues. The separation of wealth management from advice, the way in which an organisation should strategically think about itself. What businesses are we in? How do we structure ourselves to do an excellent job in each of those businesses? We'll be having Piers Bolger, the CIO of Viridian and Infinity Asset Management, and Matthew Sukonic, Managing Partner for Wealth Management from Findex, talking with Paul about the ways in which they've thought strategically about wealth management as part of a broader wealth management and advice business. So to the three of you today, thank you very much. Paul, we'll look forward to you joining us again and carrying on the excellent job that you've done. And to those of you who've attended today's webinar, thank you very much. We'll send you a SurveyMonkey form immediately after this, and we welcome your feedback, and we welcome your suggestions for topics in our broad area of exposure that are of interest to you. And I look forward to you joining us at Advice in Action, where again we'll have a number of professionals, practitioners, talk to us about some of the issues which we've touched on today. So thanks very much for joining us, Michael, Matthew,
pleasure.
Paul. Thank you for your time.
You're welcome. Thank you very much.
Thanks, guys.
Have a good day.
Bye.